Welcome back to the channel. I'm Algabot, and today we're taking an educational look at an expert advisor for MetaTrader 5 called Projection Band Trend Pullback. This strategy is built around a classic but often overlooked tool, Mel Widner's projection bands and projection oscillator, first published in Stocks and Commodities back in 1995. Over the next few minutes, we'll explore how this approach reads the slope of the market, how it waits patiently for a pullback inside a trend, and how it manages its stop and target using volatility. This is educational content only, so let's dig in and understand how it thinks. Let's start with the big picture. Projection Band Trend Pullback is a trend continuation system. That means it does not try to catch tops and bottoms or predict reversals. Instead, it looks for markets that are already moving in one direction, and it aims to join that move after a temporary dip. The engine behind it is a pair of tools designed by Mel Widner. The first is the projection bands. Rather than drawing flat horizontal channels the way many indicators do, these bands fit a least squares regression slope to the recent highs and, separately, to the recent lows. Then every past high and low is slid forward along its own slope to the current bar. The highest projected high forms the upper band, and the lowest projected low forms the lower band. The result is a channel that tilts with the trend, leaning up in a rising market and down in a falling one, so it tracks direction instead of fighting it. From those two bands, the strategy builds the projection oscillator, a value between 0 and 100 that measures where the closing price sits inside that slanted channel. You can think of it as a trend-adjusted version of the stochastic. When price pulls back toward the far band, the oscillator sinks, and when price pushes toward the near band, the oscillator rises. On top of this, the strategy adds a medium-term exponential moving average as a trend filter and an average true range reading to size its stop and target to current volatility. It's designed with liquid, trending instruments in mind, things like the major currency pairs, gold, and stock indices, on intraday to swing time frames. As always, this is a description for learning purposes, not a recommendation, and trading always involves the risk of loss. Now let's walk through exactly how the strategy makes its decisions. Everything is evaluated on the bar that has just closed, so the logic acts once per completed candle rather than reacting to every tick. First, the strategy rebuilds its projection bands over a window set by the ProjPeriod parameter, which defaults to 20 bars. It calculates the slope of the highs and the slope of the lows, projects them forward, and forms the upper and lower envelope. From those, it computes the projection oscillator, clamped between 0 and 100. Next comes the trend filter. The strategy calculates an exponential moving average over the trend period, which defaults to 40 bars. For a long setup, it wants the closing price to be above that moving average, and it wants the moving average itself to be rising. That confirms the medium-term trend is genuinely pointing upward. Now for the pullback itself. In a healthy uptrend, price repeatedly retraces toward the far band, and when it does, the projection oscillator sinks toward the oversold level, which defaults to 25. The strategy watches for the oscillator to have been at or below that oversold level on the prior bar, and then to cross back up above it on the current bar. That upward cross is the resumption signal, the moment the dip appears to be ending and the trend is picking back up. When the rising trend, the position of price above the moving average, and that upward oscillator cross all line up, the strategy signals a long entry. The short side is the exact mirror image. Price must be below a falling moving average. The oscillator must have reached the overbought level of 75 or higher on the prior bar, and then cross back down below it. That downward cross while the trend is falling signals a short entry. Risk management is handled with the average true range. When a position opens, the stop loss is placed a distance of ATRSL multiple times ATR away from entry, defaulting to 2 times, and the take profit is placed ATR-TP multiple times ATR away, defaulting to 3 times. That gives a reward-to-risk ratio of about 3 to 2 on the default settings. Only one position per magic number is held at a time, so the strategy finishes one idea before starting another. Here's the heart of the meta-editor code. At the top are the input parameters. ProjPeriod sets the regression window for the bands and oscillator. TrendPeriod sets the moving average length, and the OversoldLevel and OverboughtLevel of 25 and 75 arm the long and short pullbacks. ATR period, ATRSL multiple, and ATR-TP multiple govern the volatility-based stop and target, while lots fixes the trade size. Below that you can see how the decisions are formed. The strategy checks whether the moving average is rising or falling. Then it builds two cross conditions. Cross-up is true when the prior oscillator value was at or below oversold and the current value is now above it. Cross-down is the mirror, where the prior value was at or above overbought and now sits below it. The long condition, go long, combines that upward cross with the close being above a rising average. The short condition, go short, combines the downward cross with the close being below a falling average. When go long is true, the code reads the ask price and calls trade.buy, placing the stop loss ATRSL multiple times ATR below entry and the take profit ATR-TP multiple times ATR above. When go short is true, it reads the bid price and calls trade.sell with the stop above and the target below. Symmetrical and volatility aware on both sides. Let's walk through this illustration candle by candle to see how the strategy would trade both directions. On the price chart, you can see the blue trend EMA weaving through the candles, and in the panel below sits the projection oscillator, with the oversold line at 25 and the overbought line at 75. Look at the first two candles. Price is climbing and holding above the rising blue moving average, so the medium-term trend is clearly pointing up. That's the backdrop the strategy wants before it even thinks about a long. Now watch the third candle. Price pulls back, dipping lower, and in the panel below the oscillator drops sharply, sinking down into the green oversold zone below 25. This is the pullback the strategy is waiting for. Importantly, because the projection channel is already tilted upward with the trend, this dip is treated as a discount inside an uptrend, not a reversal. On the very next candle, the fourth one, price turns back up and the oscillator crosses back above the 25 level. That upward cross, while the close is above the rising average, is the resumption signal, and you can see the buy entry marker appear right there. From that point, follow the next few candles as price steps higher, one rising candle after another, riding the tilt of the trend. Price advances steadily until it reaches the take profit marker a few bars later, where the position closes at its volatility-based target, a distance of 3 times the average true range from entry. That completes the long side. Now the character of the market changes. After that peak, price rolls over. Watch the blue moving average flatten and begin to curve downward as the candles start closing lower and the close slips beneath the average. The medium-term trend has now turned down, which sets the stage for the mirror image short setup. Around the 9th candle, price stages a small bounce back up toward the average, and in the panel the oscillator climbs into the red overbought zone above 75. That's the counter-trend rally the short side wants to fade. Then on the 10th candle, price rejects and turns lower, and the oscillator crosses back down below the 75 level. With the close now below the falling average and that downward cross confirmed, the sell entry marker appears. From there, trace the final candles as price falls away, printing a fresh low with each bar. The move carries down to the take profit marker near the last candle, again a distance of 3 times the average true range from the entry, closing the short in profit for this illustration. Notice the symmetry. Both trades needed 3 things to align: the trend direction from the moving average, a stretch of the oscillator into its extreme zone, and then the cross back out that signals the pullback is over. And in both cases, the stop and target were set by volatility, not by a guess. Of course, this is a clean textbook example drawn to teach the logic. Real markets are noisier, signals can fail, and losing trades are a normal part of any approach. So that's a full walkthrough of the Projection Band Trend Pullback Expert Advisor. We covered how Mel Widner's projection bands tilt with the slope of the market, how the projection oscillator measures where price sits inside that channel, and how the strategy combines a moving average trend filter with an oscillator cross to join pullbacks in the direction of the trend. We also looked at how the average true range shapes the stop loss and take profit on both the long and the short side. Remember, everything here is educational content only and not financial advice, a recommendation, or a solicitation to trade. If you found this analysis helpful, please like the video, leave a comment with strategies you'd like explored next, and subscribe for more MetaTrader 5 breakdowns. You can learn more at www.OverboughtLevel. Past performance does not guarantee future results. Trade responsibly.